Meet Marcus and Devon. They're both 30 years old, both have stable full-time jobs, they both earn $70,000 a year. For years, they've lived below their means, skipping expensive vacations, driving used cars, saving every extra dollar they could, and over time, they've each managed to save $55,000. For both of them, it's the biggest financial milestone of their lives. Marcus has always believed real estate is the best way to build wealth. He likes the idea of owning something tangible, something he can point to and say, "That's mine." Devon sees things differently. He believes the best investment is the one that quietly grows in the background, without demanding his time or his attention. So today, we're not comparing every single dollar Marcus and Devon spend. We're comparing two very different strategies for building wealth. Let's follow their journey over the next 20 years, because the outcome is nothing like most people expect. My name is Tahira, and by the end of this, you might rethink which investment actually wins. Let's begin. Marcus decides to use his $55,000 as a 20% down payment on a $280,000 rental home. Nothing luxurious, just a well-maintained house in a decent neighborhood. After weeks of comparing properties and studying the local rental market, he's confident he's found one with strong potential. To finance the purchase, he takes out a 30-year mortgage at 6.75% interest. His monthly mortgage payment comes to about $1,450. Just a few weeks after closing, he finds a tenant willing to pay $1,950 a month. The numbers look fantastic. Each month, Marcus collects $1,950 in rent. After the mortgage payment, he has roughly $500 left over. It almost feels too easy. Devon takes a completely different route. Instead of buying property, he invests his $55,000 into a total stock market index fund. No leverage, no tenants, no repairs to worry about. After covering his living expenses and setting aside money for emergencies, he still has about $250 left over each month, so he sets up an automatic investment of $250 every month. Once everything is in place, he closes the app and gets on with his life. Devon's investment doesn't feel exciting. There's nothing to visit, nothing to collect rent from, nothing to proudly show his friends, just a number quietly growing inside an app on his phone. On day one, Marcus looks like the obvious winner. He owns a house, he has a tenant, he feels like someone building real wealth. Devon has nothing more than a brokerage account and a confirmation email. One investment feels real, the other feels invisible. But investing isn't about what feels impressive. It's about what actually builds wealth. During the first few years, everything seems to go Marcus's way. Rent arrives at the beginning of every month. Every mortgage payment chips away at the loan. He drives past the property after work and quietly smiles, "I own that." The house slowly increases in value. Each payment builds a little more equity. Everything about the investment reinforces the feeling that he made the right call. Devon's experience looks completely different. Every few months, he logs into his investment account. Sometimes the balance is higher, sometimes lower. Most of the time, it doesn't feel like much is happening. The gain seems small. The excitement is nearly non-existent. There's no tenant thanking him, no building he can point to, just numbers quietly changing on a screen. Marcus's friends constantly ask about the rental property. Devon's friends rarely ask about his investments. From the outside, Marcus looks like the successful investor. Devon just looks patient. 3 years pass. Let's compare where they actually stand. Over those 3 years, Marcus collects roughly $70,200 in rent. His mortgage payments total approximately $52,200. On paper, that's nearly $18,000 in positive cash flow. But there's one problem. That number only exists on paper. Because the moment you own a rental property, the bills begin arriving. Property taxes, insurance, routine maintenance, a month here or there without a tenant, advertising the vacancy. Individually, none of these expenses feel overwhelming, but together, they quietly eat away at what once looked like easy profit. Then there's Marcus's own time. To save money, he manages the property himself. late-night calls from tenants, weekend inspections, meeting contractors, scheduling repairs during his lunch breaks. By the end of those 3 years, the $18,000 he thought he'd made has shrunk dramatically. After accounting for every genuine expense, Marcus has realistically kept only a few $1,000s, and that's before his own time is factored in at all. Devon, meanwhile, has experienced something far less dramatic. His original $55,000 has continued growing, with another $250 added every single month without interruption. Assuming a long-term average return of around 10% annually, his portfolio has grown to roughly $84,000. He hasn't answered a single phone call from a tenant. He hasn't repaired anything. His money has simply continued working quietly in the background. But Marcus still has one enormous advantage: leverage. His property was purchased for $280,000. After 3 years, its value has climbed to somewhere between $305,000 and $310,000, depending on the local market. Meanwhile, every mortgage payment has reduced what he owes. His equity has climbed to roughly $90,000 to $95,000. That's genuine wealth, and a large part of it came from controlling a $250,000 asset with only a fraction of his own money. That's the unique power of real estate, something stock investors can't easily replicate, and one of the biggest reasons property investing has built so many fortunes over the decades. But here's the part almost nobody talks about. The rent check makes rental property look like easy money, but rent isn't profit, it's only where the story begins. Because before that money reaches your pocket, every rental property comes with a long list of expenses. First, vacancy. No rental stays occupied forever, and a good rule of thumb is to budget for roughly 1 month of vacancy every year, 1 month with no rent coming in while the mortgage still has to be paid. When a tenant leaves, another set of costs begins: cleaning, fresh paint, minor repairs, advertising, screening new tenants. Every turnover quietly eats into your returns. Then there's ongoing maintenance. A rental home is a physical asset, and physical assets wear out. A leaking faucet, a broken appliance, an air conditioner that suddenly stops working. A common rule is to budget around 1 to 2% of the property's value every year for maintenance. On a $280,000 house, that's roughly $2,800 to $5,600 annually. Some years you'll spend far less, other years much more. Then come the big-ticket repairs: roofs, water heaters, furnaces. These aren't unexpected, they're inevitable, the only question is when. And when they happen, the bill often runs into thousands of dollars. One repair can wipe out months of rental profit. Finally, there's the cost of managing the property itself. Hire a property manager and expect to pay around 8 to 10% of your monthly rent. Manage it yourself, and you're trading money for time instead. Either way, someone pays. That's why experienced investors never calculate rental profit using just one equation. Rent minus mortgage is only the beginning. The real numbers don't appear until every hidden cost is included. And that's exactly what Marcus experiences. Month after month, year after year, the expenses slowly add up. 5 years in, Marcus is no longer the excited first-time landlord. He's become an experienced one. He's already rented the house to 3 different tenants. The roof eventually needed replacing. A plumbing emergency appeared out of nowhere. The property sat empty between tenants more than once. Fortunately, rent has increased to around $2,100 a month, but so have property taxes, insurance premiums have climbed, and maintenance costs continue rising. After adding everything together, Marcus's actual cash-on-cash return settles somewhere around 3 to 5%, still respectable, just nowhere near the 15 to 20% many people casually claim online. Devon's investment journey looks almost boring by comparison. Nothing dramatic has happened. He hasn't switched strategies, hasn't chased hot stocks, hasn't tried to predict recessions. Every month, another $250 automatically goes into his index fund. That's it. By year 7, his portfolio has grown to roughly $128,000. And something important is beginning to happen. His investments are now generating more growth each year than many of his annual contributions. This is where compounding quietly changes gears. The first few years barely feel rewarding, then the gains begin producing their own gains, and every year after that, the curve becomes steeper. Underneath the surface, both investors are building wealth, just in very different ways. Marcus's wealth depends on leverage, appreciation, rental income, and active management. Devon's wealth depends almost entirely on time. One requires continual involvement, the other requires continual patience. By year 10, the comparison becomes much more interesting. Marcus's rental property is now worth somewhere between $370,000 and $410,000, depending on how the local market has performed. His remaining mortgage balance has fallen to roughly $190,000. That gives him approximately $180,000 to $220,000 in equity. Not bad at all. But building that equity hasn't been free. Over the past 10 years, Marcus has spent roughly $33,000 on property taxes, insurance, maintenance, repairs, and vacancy costs. Devon's portfolio tells a different story. His original $55,000 investment, combined with 10 years of steady monthly contributions, has grown to approximately $185,000 to $195,000. Over that decade, he's personally invested around $85,000. Everything above that has come from market growth alone, no leverage, no tenants. At this point, something surprising happens. Their total wealth is remarkably close. Depending on appreciation, Marcus may even be slightly ahead, thanks largely to leverage, but numbers alone don't tell the whole story. Marcus reached this point while carrying hundreds of thousands of dollars in debt. His entire investment is tied to a single property in a single neighborhood. He's spent hundreds of hours managing it. Devon owns tiny pieces of thousands of companies spread across the economy. His investment can be sold almost instantly, and outside of one automatic monthly contribution, it has demanded almost nothing from him. Here's something almost nobody factors into this comparison: taxes. Rental income is taxed as ordinary income each year, though depreciation can offset a portion of it. Devon's gains, as long as he doesn't sell, aren't taxed at all until he does, and long-term capital gains rates typically run lower than income tax rates. It's not a decisive advantage for either side, but it changes what each of them actually keeps after the government takes its share. There's also liquidity to consider. If Devon urgently needed cash, he could sell shares and have the money in his account within a couple of days. If Marcus needed the same amount just as urgently, he'd likely be looking at months, a sale process, a refinance, or an expensive bridge loan in the meantime. That flexibility carries real value, even in years when nothing goes wrong. By year 10, neither investor has clearly won. They've simply taken two very different paths toward almost the same destination. Another 10 years pass. Now we're looking at the full 20-year picture. Marcus's property has continued appreciating over time. Depending on the local market, it's now worth somewhere around $555,000. His mortgage balance has fallen substantially. After 2 decades of ownership, he's built approximately $430,000 in equity. Throughout those 20 years, the property has also continued generating rental income, but it has continued generating expenses too. When every dollar is counted, Marcus has generated roughly $135,000 in net cash flow from the property after all expenses. Some investors will do much better than this, others will do worse. Real estate depends heavily on the market you buy in, the tenants you attract, and how well the property is managed. Devon has experienced a very different 20 years. His original $55,000 has quietly continued compounding. Every month, another $250 has been invested automatically. Nothing exciting, just consistency. Assuming the market delivers its long-term average return of around 10% per year, his portfolio has grown to approximately $535,000. Over those 20 years, Devon has personally contributed about $115,000. The remaining roughly $420,000 came purely from compound growth, no debt, no tenants, no repair bills. When you compare their net worth after 20 years, the result surprises most people. Marcus finishes with approximately $565,000 in total wealth. Devon finishes with approximately $535,000. Two completely different paths, almost the same destination. Yet the journey couldn't have been more different. Marcus built his wealth through leverage. Devon built his through compounding. Marcus accepted concentration risk. Devon accepted market volatility. Marcus invested time alongside his money. Devon invested patience. Neither approach is automatically better, they're simply different. At this point, it might sound like the stock market is the obvious choice, but that wouldn't be a fair conclusion either. Stocks come with risks that are every bit as real, they're just easier to ignore. Market crashes can be brutal. Broad stock indexes have fallen by nearly 40% during major downturns, and in some sharp corrections, dropped more than 30% in a matter of weeks. Imagine opening your investment account and watching years of savings disappear almost overnight. That can be genuinely difficult to sit through. Stocks also don't produce meaningful monthly income for most investors. Yes, index funds pay dividends, but the yield is relatively small. A portfolio worth $150,000 might generate only around $250 a month, useful, but nowhere near enough to replace a full-time income. Leverage is another major difference. Devon used $55,000 to buy $55,000 worth of investments. Marcus used the same $55,000 to control a $280,000 property. When property prices rise, that leverage magnifies the gains. The stock market simply can't replicate that. So which investment actually wins? That's the wrong question. Marcus believed buying property was the proven path to wealth. Devon believed the stock market would quietly do all the work. Both were only partially right. The real winner wasn't determined by the investment, it was determined by understanding everything that came with it: the money, the time, the stress, the risk, and the opportunity cost. Before you decide which path is right for you, ask yourself 3 questions. First, do you actually have the time and temperament to manage a property, or do you want an investment that runs itself in the background? Second, how would you genuinely react if your balance dropped 30% in a single month? Would you hold steady, or would you panic and sell? Third, how much do you personally value being able to access your money quickly if your life or plans suddenly change? The truth is, there isn't one perfect investment, only the one that's right for your goals, your temperament, and the life you want to build. So the next time someone tells you that real estate always beats the stock market, or that the stock market always beats real estate, ask them one simple question: did you include everything? Because the answer that includes everything is the only answer that truly matters. If this comparison helped you think differently about your own investing path, make sure to hit subscribe. And I'm curious, if you had $55,000 to invest today, which path would you choose, and why? Let me know in the comments.